I'm Max Kaiser. Welcome to On the Edge. Time now to go to London and speak with independent energy analyst Chris Cook. Chris Cook, welcome back to On the Edge.
Hello again, Max.
Chris Cook, oil prices continue to soar. Tell us about J.P. Morgan's role.
Well, certainly I don't think J.P. Morgan have a role in the what I would call the speculative spike that's going on. But I think that the investment banks, J.P. Morgan is one, and of course our old friends Goldman Sachs are another, have certainly had a role in building up the bubbles. There have been two bubbles, one from 2005 to 2008, and I think of that as a private sector bubble, Max. That one was, I believe, down to Goldman Sachs and probably BP together, maybe others. And I think from 2009 that got started, the bubble got pumped back up again. And I see that as a public sector bubble. And that, I think, was our friends J.P. Morgan working closely with the Saudi Arabians, with whom they've had a long-standing relationship going back into about 1933, I think it was. But what we're currently seeing is not a bubble. As I think I've explained before, bubbles are inflated by funds investing. We're talking about risk-averse investors here, all the people who are getting out of the dollar and into commodities, into gold, into equities, into anything but dollars, actually went into, through the investment banks, were able to actually acquire rights to what I call paper oil. And it was Goldman who first did that in the private bubble. We now see a public Saudi GCC bubble, I believe. And what we're currently seeing is a speculative spike. Yes, the dreaded speculators are, in my view, about to spike that bubble.
All right, now you mentioned the U.S. dollar, and you can't really talk about oil and gold and the bond market without talking about the U.S. dollar. The U.S. dollar seems to be stuck in a trading range for a couple of years now, and there are certainly those who have been very bullish on the U.S. dollar as a way to play the recovery in the U.S. and the recovery in various sectors in the U.S. Others are looking at the trend as being negative and for the dollar to test the new all-time lows down at around 70, 71 on that dollar index that's most frequently quoted. I would. How do you weigh in on the dollar, and then we'll bring it back to the oil market.
What happens is people get into one thing and out of another, and you mustn't forget that the commodities are priced in dollars, and there are two things here. There's the dollar as a pricing unit. And of course, that's the global pricing unit. That's one thing. And then there is, well, what happens when people actually sell oil and they get the dollars in return? Well, they have to put the dollars something. And therefore, Max, what we're seeing is not so much a flight into dollars as, well, T-bills are the safest asset on the planet, many people actually believe, because at the end of the day, when in an uncertain world, who has more nuclear weapons and army than anybody else? And it's the US. So I think, you know, in a flight to safety, that's why people actually buy not so much into the dollar, Max, as into assets, into dollar assets like T-bills. And that's why we see, you know, 0% interest rates. That's why we see it, you know, 0% practically out to 2 years and nominal rates right out to 10 years. You know, you've got to distinguish between the dollar as a pricing reference and dollar assets, you know, dollars, if you like, sold forward in a sense.
Well, talking about, you know, you could put the British pound pari passu with the U.S. dollar. I see that the U.K. government is in the process of floating or exploring the idea of floating 100-year gilts, 100-year British Treasury bonds. They want to lock in the current low rates. Your thoughts, Chris Cook?
They're not just looking at 100 years, Max. You know, we're talking about permanent or perpetual bonds, which have been sitting there since in the mid-19th century. In fact, they go further back than that. And then we have what's called war loan, which, as the name implies, was issued during the First World War. And they basically haven't got round to actually buying those back, although we've read recently that they're thinking about, because it's a 3.5% interest rate, they're thinking that it might make sense to actually redeem the war loan and maybe issue something else. So, you know, there's nothing new in a sense about long-dated or even no-dated government debt. That's been around a long time. You've got things called consols, which are 2.5% redeemable. Think of UK PLC redeemable preference shares, Max, and you've got an idea as to what consols are. They go back hundreds of years.
All right, Chris Cook, you mentioned these war bonds that have a 3.5% coupon. The idea is to call those bonds in and to issue new bonds, presumably taking advantage of new lower percent interest rates. And to finance all of this, the Bank of England is expanding their balance sheet. They are becoming more encumbered with debt that they have to pay someday. The Federal Reserve Bank now has a balance sheet over $3 trillion. The European Central Bank's balance sheet is now over 3 trillion euros. So these central banks are expanding seemingly infinitely. They're issuing paper that has no maturity date. Why would I even bother buying oil or any tangible asset if there is absolutely no way to price a tangible asset? There is no pricing mechanism. There's no pricing discovery. It's a completely centrally planned command and control economy in Britain and the U.S. There is no competition. There is no price discovery. So why should I even bother buying oil?
Well, I've said for a long time now that the oil price, the pricing mechanism, which is the North Sea oil pricing mechanism, is completely dysfunctional. I said that in evidence to the Treasury Select Committee 3 years ago. And in the last 3 years, the oil production in the North Sea has come off quite a bit. Last year, Max, it lost, I think, 18% of production in the North Sea. The decline was 18%. Now, that doesn't make the North Sea benchmark any better, as you can probably imagine. It just means that the oil price is that much easier to manipulate and to support. And if there's one thing you know about the producers, producers in the oil market, if they can support prices, if they can manipulate prices, then they will. And we've seen that across so many markets over the years. We saw it in the tin market with the tin cartel, which ended in a collapse from $8,000 a ton to $4,000 a ton in 1985, literally, Max, overnight. That is what worries me as a former regulator. I see the oil market as potentially, the support is practically drained away from under the market, I believe. We're completely being misled as to the true state of affairs. I think there's a major vacuum underneath the oil market, and I think that because the oil pricing mechanism is completely dysfunctional, completely invalid, it's just almost mythical. I think that it is an accident waiting to happen, and my forecast, as you well know, is that we can expect to see the market fall out, either go in a managed decline or literally collapse before the end of the second quarter of this year at the latest. It could be much quicker than that. John Kemp of Reuters, somebody who I respect greatly, was saying that the possibility is there for a flash crash, as occurred May the 5th last year. We saw the NYMEX price, I think it went limit down. And he's saying that the market is completely exposed to a similar flash crash right now.
All right, so what we're talking about here is that you have to play the players and not play the market, because they have major players. They're manipulating the price, whether it's Treasury market, the oil market, stocks, bonds. There is no price discovery. There is no supply and demand. At some point, though, supply and demand curves do kick in. There is a return to reality. And so on the supply side of this equation, let's talk about Saudi Arabia, because Saudi Arabia has been asked now to make up for the shortfall in production in places like Libya and other places. And of course, the oil is a finite resource, and Saudi Arabia, they haven't had their barrels audited in quite some time. They seem to indicate that they can pump oil as easily as Tim Geithner can print treasury paper and dollars over there at the Fed. Is Saudi Arabia, are they going the way of Cantarell in Mexico and Bergen in Kuwait? That is to say, have they hit peak production on the cheap stuff?
It's hard to know, because one of the greatest secrets on the planet is the true state of Saudi production. I certainly don't believe it's as comfortable as they say it is. I do believe that they probably have some spare capacity, but some of it's pretty toxic stuff, full of vanadium, quite heavy quality, and might not be possible to produce it for some time. I think also you need one of the interesting points is that you need to distinguish between the capability of a producer to produce and the capability of a producer to actually load oil out of stocks. And on the other side of that coin, there is the capability of people to consume oil and the capability of countries like China to put it into reserve, to put it into refinery stocks, etc., etc. And there are some massive misconceptions, Mark, as to the role, for instance, of inventories. Many good commentators are actually saying, oh, inventories, private inventories are low, therefore demand is high. Well, I'm sorry, that's not how it works in the oil market. The middlemen, the Vitols and the Trafiguras and the investment banks aren't really involved in this game anymore, holding oil. What those guys have to do is actually be able to actually finance the stocks, point one, and also they need to actually be able to lock in a profit, point two. And if the market price today is in fact greater than the market price tomorrow, a situation which has been happening recently called a backwardation, what happens is these people, they won't hold oil in their own inventories. They will sell it. It's uneconomic to store because they have what I would call deflationary expectations of the price.
You mentioned earlier that the dollar is backed by the biggest war machine in the world. And starting with the 1970s, of course, the U.S. went off the gold reserve and they went on the petrodollar reserve. And at the moment, you've got a situation where the bellicose and belligerent and saber-rattling talk toward Iran is escalating. Of course, this drives the price of oil higher. So isn't it in the purview of the warmongers and war profiteers to simply continue to antagonize Iran? And if they have to, they'll invade Iran, if that's what it takes to keep the price of oil higher.
Who benefits from having the price of oil higher? Iran benefits from having the price of oil higher. Now, I don't think that the US benefits from having oil higher and gasoline approaching or exceeding $4 a gallon. I don't see that as in their interest at all.
Let me cut in here for a second, Chris Cook, because you say you're not sure that the U.S. would benefit from this higher price of oil. But we're not talking about U.S. citizens. We're talking about U.S. corporations, multinational corporations. They're not beholden to U.S. law. We know this. None of the oil companies, just like the banks, they're not beholden to any law. So it's not about a U.S. objective. I mean, the oil companies are their own entity, Chris Cook, isn't that so? I mean, they're not beholden to any governments. I mean, please, let's not be naive, right?
That is true. But you know, there are companies and there are companies. First of all, I don't think it's in any big corporation's interests that America goes into a recession or a depression. And one of the biggest costs that weighs on the US, because they're one of the biggest consumers of crude oil, one of the biggest costs is the price of oil. So, you know, I don't think any big corporation over there, apart from the odd big oil company who has lots of production, and there aren't many of those, Max. Most oil companies these days, more or less, actually act more like service providers, refining the stuff and distributing the stuff and trading the stuff. Sure, they make money with high oil prices, but don't forget, Max, also, you know, they don't want to kill the goose that lays the golden egg. You know, American demand for gasoline has been falling rapidly. In the EU, with dollar, you know, with sterling prices and euro prices have never been higher, right? I mean, the previous bubble, it was the US that took the hit with $5, you know, $5 per gallon gasoline. This time around, we're not talking about that. The US are sort of, because of the dollar-euro exchange rate, It's not quite like, you know, they say that history it never repeats itself, Max, but it does rhyme. And this time around, what we're seeing is the Europeans and the Brits, you know, taking the hit, and we're seeing demand falling off a cliff. You know, that's the reason why Petroplus, with 5, you know, European refineries, has shut almost all of them. Okay, because the demand's falling off a cliff. And what does that do to crude oil demand, do you think? Well, if you listen to the investment banks who have funds to sell you investing in crude oil, well, it's going to increase demand. But, you know, I'm afraid at the end, that is not how it works. For the US, Max, you know, we're talking about 2 million barrels a day of refining capacity has essentially gone out of business because the crude oil price is high, has been inflated in my view, and there's a limit to what they can actually, you know, screw out of the US consumer. I'll give you an example. The refinery, the Hovensa refinery in St. Croix in the Virgin Islands, US Virgin Islands, that's a joint venture between Hess and the Venezuelans. 350,000 barrels a day, up to 500,000 of Venezuelan crude being, you know, refined. That stopped, Max. They were losing 1.6 billion a year. It stopped. What do you think is going to happen to the oil price? Do you think the Venezuelans are going to be able to sell that oil more expensively on the oil market? Of course they're not. They're going to have to go knocking on the Chinese doors or whoever and say, would you take this heavy crude quality from us? So I'm afraid there has never been a reason why an investment bank ever thinks the oil price will go down. Because, Max, they have funds to sell you. And those funds are what keeps the oil price inflated. You know, this is hedging inflation, as they call it, the investment banks, actually causes inflation. This is what Soros calls reflexivity. You could not make it up. The manipulation of the oil market has been going on, in my view, for at least 10 years. I just think this is so big, it's the elephant in the room. People cannot see what's going on here. Nothing to do with speculators, Max, apart from the odd spike, which pricks the bubble. We're talking about producers wanting the highest possible price, and we're talking about risk-averse investors, pension funds, retail investors who have been sold by investment banks on putting their money into actually hedging inflation. And I'm afraid it's going to end in tears, and it's going to end in tears pretty soon.
Right, okay, so the hedging actually is increasing the price. Similar when I was working on Wall Street in the 1980s, we were selling portfolio insurance to customers as a way to hedge against a collapse in the price of the Dow Jones. And we sold so much of this stuff that we caused first the inflation to all-time highs and then the crash, of course, of 1987. So here you have it. What you're saying is the money that's created to sell the hedge funds, essentially loaned into existence, in fact is a debasing of the currency, which causes ultimately a bigger problem than if you had not created these so-called hedging instruments to begin with. But you mentioned that the U.S. doesn't want a recession. But again, you know, let's emphasize that the U.S. is an economy that's splitting apart. The wealth and income is gapping wide, and that's by design. And those who are in the banking business and the oil business, these two industries have grown up over the past 30 years. The credit industry, the Wall Street industry, has gone up thousands of percentage points along with the oil and the globalization of the global economy because oil is an extraordinarily expensive business to be in. The drilling and processing and shipping of oil, you need credit, and this has fueled Wall Street. So the fact that there's a recession, remember, it won't be a recession for Wall Street. So the recession is not a reason to assume that this is not going to continue as is, because Wall Street has a vested interest in continuing this scam. The low interest rates, their cost of financing is zero. They can pick a war anytime they want to keep the price high. So again, I have to ask you, what's going to drive this collapse? If you've got unlimited free money, 0%, you get bailed out whenever you make a mistake, there's no price correction, there's no price discovery. Why is price of oil going to go down? I don't get it.
Max, what you're missing here is that basically in October 2008, I call that the point of peak credit. At that point, the deficit-based system that we have died. We're now in it's not a matter of liquidity, Max. There's oceans of that. The Fed can print unlimited amounts of money. What we're talking about here is capital. The banks have zero capital. In fact, they're underwater, Max. You know, we're talking about the, what's it they call it? Extend and pretend, you know?
Chris, the banks haven't had capital in 20 years. The U.S. runs on a negative reserve requirement. There is no collateral. It's purely debt on top of debt. And there's no reason to stop that debt being created ad infinitum. There's no corrective.
Max, I agree with you totally in terms of printing money, but I will tell you this, it is not the banks who are actually speculating in the markets. The banks are not taking positions in the market. What the banks have realized, and this is the interesting thing in the last 3 years, they realize that the banks don't have to take the risk of the market price falling. Because what the banks have been able to do is convince the retail investors to take the risk of the market price falling. The banks, Max, have changed their business model. That's what people don't understand. The banks are no longer taking the market risk, which is what they did before, right? They haven't got the capital to take. They've got the money, the liquidity, but they haven't got the capital to do it. They can't afford that loss. And so what we're looking at the moment is that the banks have changed their business model. They're selling funds to people who should not, to risk-averse people who should not be buying into oil at $125 a barrel, okay? You know, when in fact the risk is there. The Qataris have been hedging at $60 up down to 45. They did it, last November. And yet, the banks are selling funds to people, to risk-averse investors, at $120 a barrel. Max, if that isn't an accident waiting to happen, I don't know what is.
All right, we've got about 10 seconds, Chris Cook. As a matter of fact, we're out of time. We're going to have to continue this conversation at another date, but always fascinating to get your view. Chris Cook, thanks for being on The Edge.
It's been a pleasure, Max. The time has flown.
All right, that's going to do it for On The Edge with me, Max Kaiser. I want to thank my guest, Chris Cook. He's always got the best stuff on what's happening in the oil. Look him up on the web. If you want to send me an email, please do so at ontheedge@presstv.com. Until next time, Max Kaiser saying bye, y'all.